Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Morningstar Investment Management's Dan Kemp. Hello, Dan.
Hello, Emma.
So we've had extreme volatility in markets over the past 18 months. And a lot of people are very nervous about this. They're nervous about what this means for their portfolios. But it doesn't necessarily mean that portfolio is experiencing more risk, does it?
No, that's absolutely right. So volatility is a statistical measure. It's not what we think about when we think about risk. It is a relevant measure for some people. People need to be able to cope with the day-to-day volatility to stay invested for the long term. It's particularly important if you're drawing an income from your investments after time, but it's not the main measure of risk. The main measure of risk is permanent loss of capital. Is that money going somewhere where you're never going to get it back? And that's what we think about in the investment management team.
Of course, this ties in with lots of people's feelings about benchmarks as well, because fund managers can turn around and say, but I beat the benchmark. And the investor might turn around and go, but you lost 20% of my money and I wanted to take it out at that point. It's all about, as you say, when you're going to capitalise, or crystallise rather, those losses, and real loss of money is, of course, risk.
Absolutely right. And volatility, again, tends to be that sort of shorter term measure. You get caught by volatility, but really, if you're a long-term investor, if you're saving for your long-term retirement, then you need to embrace volatility because that's when the real opportunities come along. Volatility allows you to buy things cheaply, and that's what we all want to do in investment.
But it's easier said than done, isn't it? Because market timing is famously difficult to do. So how can investors use this knowledge that volatility is an opportunity and not a risk in order to maximise their returns?
Well, there's a few things that people can do. The first is, again, to maintain that long-term perspective, providing they are long-term investors, and be able to look through this volatility. The second is make sure that the portfolio that you're investing in is the right level of risk for you in the starting place. And then finally, don't try and time the market. Very few people, if anyone, can do it, but gradually invest over a long period of time, again, to capture the benefits of what we call pound cost averaging.
And this is, of course, can be done through an advisor if perhaps you want to take the responsibility away from yourself, or indeed from drip feeding. If you invest £50 a month, every month, and it's taken out of your hands, you're automatically going to be buying units when the market dips. And of course, those units can grow as the market picks up again.
That's absolutely right. And so there, if you're buying over a long period of time, you're doing it regularly, it's a part of your routine, then that's by far the best way of investing.
And it's one of the philosophies that we have here at Morningstar as well, with the Morningstar Investment Management team, isn't it?
Exactly right. We are all long-term value guys. We get strangely excited when the market falls because it gives us a great opportunity to buy things more cheaply. Equally, when markets rise very strongly, we get slightly sad because we have to sell things that have become overpriced. But again, we're always focused on what's going to happen over the long term, where we're going to get those best returns, and try and ignore that day-to-day noise, that day-to-day market volatility as much as we can.
And putting the end investor first.
We always put the end investor first.
Dan, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.